Dan Hupsher. My firm is Changing Out the Strategies. I'm a 361 firm affiliate. I work with hedge funds that do quantitative strategies, including quantitative crypto and a bit of crypto venture as well.
And you heard from me, I'm Safar Ashti. Rob Colorino. I'm a director at AIAC Group. We're a single-family office with current interests in 24 countries. We like special sits. We bought businesses tech-wise from EMC, the software company, from Pfizer, from Carlyle Group, from Merck, and Raytheon. And we also own Bradford Space, which is kind of like sexy space science related. Good to see a number of you all.
My name is Brooke Pollack. I'm the managing partner of Hut Capital. We're a blockchain venture fund of funds platform. I spent, I guess, a decade prior to that in more traditional private equity and venture world, and went full-time into the blockchain and crypto space in 2018 with Hut Capital.
So I'm Jeannie Stein, and I run our family office, and I invest in VC firms, in a couple of VC firms in Silicon Valley, and also abroad, and I invest in companies too. My background, I study electrical and computer engineering, worked on PhD in AI and computer vision, so I am like the techie person usually in the group.
Alfie Rustum, entrepreneur, CEO, founder of Defend Nature Interactive Web, building games. We're trying to gamify the regeneration of nature. So we've got some superhero man, and we're developing across multiple platforms. First game is coming out in a few months, and we've got the movie in development, as well as the Bioverse, which is going to be an immersive gaming experience to get kids and gamers regenerating the world, the real world. So getting them out of the game and into the real world, doing some good there. So that's
I guess you want to go or
go.
All right. Cam Hassan, I'm the CEO of Everest. I've done a few different investments in the past, focused on telecom, on automotive, co-founded a car company, kind of an exotic car. The type of car that, you know, the people that buy it probably have half dozen car already, if not more. So I always say I created product for a billionaire, now I'm going to create a product for a billion people. I'm collapsing all my knowledge from the past to focus on transportation, because I feel like this is the most impactful way I could contribute to society. And the model is very similar to, let's say, in some way in car sharing, some way to Uber. It's been done in Jewish community kibbutz, where you have cars that are shared for the entire community. That's what I'm trying to do, scaling out to be global.
Jeff? I'm Jeff Stevens. I guess entrepreneur, I guess. Dabble in a few different things like real estate, art, and promotional pickleball. We're actually talking to Alfie about getting product placement in his book.
Yeah, I'm done.
Why don't you tell them that you play 35 hours per week every week? You're the only person in the room who has that distinction, playing pickleball 35 hours.
That's why he looks the way he does.
Yeah, I play every day. I live here in Naples. I live in this complex, in fact, and play in the park until it gets as insanely crowded as it was this morning. You have no idea how lucky you were to be out there, because people were waiting 20 or 30 minutes to get one game in and then get off. So yeah, I've done a thing where I've helped market real estate through Dazzleball, where we play pickleball in the dark. And so I want to make it into a global consortium, you know, that could be used for charities or other kind of special events. And so you'll be seeing Dazzleball played in the biosphere.
Absolutely.
It's the transition point.
There you go. You did it in 15 minutes, which I think is a record for
Not bad.
kind of this size.
Not bad.
You did that?
That could be actually one of our.
You did that?
Yeah, he's
Well done.
He's our moderator.
If you've been around other 361 events recently, you might have sensed that venture is not very popular. It's really frowned upon. It's a broken model. It needs to be updated. You can't really trust it. It hasn't delivered. Of course, I'm biased. I don't think that's the case, and I have some stats that I think will support that. But I wanted to first maybe start with that. And of course, I'm not the only one setting the question. So please, everyone, if you feel there's a topic that we should discuss, just jump it in. But I wanted to just start by thinking about how do you view venture as an asset class? What are the challenges? How do you think it's been performing? Do you really think it's a broken model or not? And where do you think are the opportunities? So lots packed in there, but start from anywhere that you like.
The one panel is called Disenchantment.
That was a disenchantment.
I've got a thought, and you know, I was at something last week and with some institutions, and they brought up venture in a good way, that they're actually looking at this asset class more, and I thought that was encouraging. One, they want big checks and they do good due diligence, but what surprises me is that they haven't been there consistently the whole time. It has been mainly, family offices, foundations, and the like. So, is there a movement towards more transparency? Is it something that people are getting more comfortable, less volatility? I mean, Jack, you've been, we've talked about this about a year ago. I was just curious, is there more movement going on to getting these institutions more aligned and on board? Because that gives comfort to, actually some of the retail.
I pretty much think what I thought a year ago. Do you remember what I said?
For Washington D.C. stuff?
There was a test. No failed.
A year?
If you can't remind me of what I said, I can't repeat it.
It was just more the institutional side coming to bear, because all these venture presentations I receive, I see these mind-boggling IRRs. It's like fantastic, 30s,
That's the challenge.
Yeah, but then when you sort of drill down, and I'm saying to myself, well, if that's getting that, and real estate and infrastructure is getting 12%, the natural is, why don't you go where the return? So,
well, I mean, that was one of the stats that I shared last time on the panel on the VC that Joe, what's his name? Mylar was conducting. And it was not looked upon nicely, because they said, no, this side is not nice, it's not correct, because it has the bias of picking the ones who actually stayed in the business. But the stat was from Cambridge Associates that showed over the past 30 to 40 years, 35 years at least, as an asset class, venture has outperformed every other asset class, including real estate, including public equities. And this has been the case in terms of what I've been looking since I got involved with venture for the past 5-10 years, that the stats have been continuously the same. You might have a year up and down, but it is a saying that as an asset class, especially early stage venture, outperforms. But I think the challenge is that, as you said about transparency, there really isn't as many measures that you can put out as you have with public equities, with other asset classes, to say this is why it has outperformed. You have to have a faith in the entrepreneur and the system, saying that this is going to solve a problem because it's going to make search available to everyone. So how do you get comfortable with that? And I think that's part of the disconnect that we have some investors having about asset classes.
So may I just step in as an investor? The asset classes have dispersion of the returns, and within public equity, that dispersion is 1% to 2%. Everybody's kind of followed the index. And then it gets a little wider, right? And the dispersion is justified by the fact that it's locked up, so you get the lockup period. It's justified that by the fact that you take the risk and buy in innovative companies that then don't have any revenue, so the early stage, by expectation, should outperform the gross equity, and that has been the case. But if you look at the same Cambridge statistic, the dispersion of returns in the venture is between -2 to 30 plus. So because of it, all the institutions have been fighting for the top 1% of 1%. The Sequoias of this world, the Andreessens and Lightspeeds and so on. Why? And so then what happens is the left hand feeds the right hand, so the best deals get shared by the best guys. If you look at the numbers from Ribbit, if you look at numbers from Sequoia, we would invest and say, who's your follow-on? And you need to have those best names in it, and that just has been recurring sort of trend. You can't really blame institutions for them, because if you are CIO of a pension fund, you can sit on 10 billion and your salary is 100,000, not million, in billion, right? So what do? You have an annuity and stability of your income. You want to make sure you buy that first 1% or 1%. So that's what it is. And then from there, impact is the venture here to stay? Of course. We went from B2C, we're now going to do B2B. The technology is going to affect every industrial sort of sector, is going to affect our life and continue to be here. The question is, how do you find the ones that are here to stay? And there will be more zeros in venture. The discounts on the secondary is like 45 to 70%, right? So you really need to do your work. Exactly what you're saying. But
there's a lot of money out there for the right idea from the family offices that we work with. If you look at, Safa mentioned AI, some good healthcare. There's a lot of stuff going on with manufacturing drugs. Has always been very expensive. Generic drug space. Mark Cuban's in that space. A lot of technology changing that. The question for you, if I can ask maybe the group too, is when we work with family offices, they say, what's the return? Is it 5-7 years? And now, unfortunately, it seems like that's creeping up to more like 10, 12 years. When are we going to get our money out, if we do at all? And they understand the risk. If you invest in immuno-oncology as an investment, people are doing that more from a charity standpoint. But from an AI standpoint or different technologies, the return on investment has gone up, and that's been a concern from venture. So would you agree? Yeah, duration, yeah. From an exit standpoint.
Mr. Biotech long-term guy here.
Yeah, I don't think that these top venture funds are smarter.
I'm not saying that they are. I'm just saying that's what happens.
I think that venture inherently has a huge portion of its risk embedded in financing risk, and what those large funds have is the ability to make sure that financing risk is not the issue. And that's an ability that very few others have, because there comes these stages, Series C, Series D, where you need huge checks, and it requires several huge check writers to produce those rounds. And they have the ability to share deals among themselves. It's difficult for someone not in that league to find as much partner money as they're able to find in their partners. So I think that's a big problem to be solved, because there are just innumerable technologies that are incredible, that have decent visibility with regard to the odds of working, that die on the vine because those big funds simply can't do everything.
I agree with you 100%, and that happens today with the early stage. So the funds that are funding early stage, they say we need to have enough money to make the company run rate for the next 24 months, because we do not know if we are going to be able to raise the Series A and Series B, which is previously in the last 5 years was easy and no longer.
I think there's another big problem in venture, is that there's this kind of practice, this conventional wisdom, that a fund not lead 2 rounds consecutively, and that imposes additional financing risk, because no one knows that company better than the fund that led the last round. And for a company's future to be dependent upon that middling fund's ability to find that next lead, and keep in mind they don't have that kind of muscle as those top venture funds to bring in that next lead.
So that's why the dispersion is higher among the non-top tier firms that you mentioned. Top tier firms are the ones that people seek, and I would suggest to you it's because the dispersion is low, but the return actually is sometimes quite higher from the
That's why I said it's due diligence. It's a high quality due diligence, underlying manager, what they invested, what are the sort of track record, how they think about the supporting the company. So it's just doing the work. And I think one thing that I hope family offices are more aware of, there was such a hype in the last 5 years of co-investing. I need to be in this deal, I need to be in this deal. And luckily today, there's a lot of deals. You have to be really careful. We say not a lot of no, right? We have to, so investing with the funds you trust is the better, safer way, playbook. and then co-invest in the same deals that they support, right? So picking the winners. But I think family offices and entrepreneurs, we have to be really careful not to rush into the investing in a specific company in size, because the environment is still quite risky.
See, that's the thing that surprises me when I talk to a lot of family offices. They invest in individual companies, sometimes later stage, which to me is a much higher risk, because as a fund, we invest in 30 companies, so at least it's dispersed. I might have several write-ups, but you wouldn't necessarily notice it because our fund one is still up for Naples.
So look, 5 more minutes. What do we want to do next as a group, as a platform, right? By the way, we had one of our best events discussing this was 2-3 weeks ago.
We referenced Joe in our
Yeah, that was great.
And all the people that were there.
We did reference people that were there.
So Todd Rupert, how can he be in so many deals in so many countries?
You talk about between them how many funds they have history.
So Eric Schmidt's family office, he gets 80, 90K ones. He says, no one's going to audit me. No one wants to audit me. You have Colia Miller, it's PCI Wireless family next to me, Forum Park, New Jersey, 50 funds. Grosvenor, another 80 funds. And they're all disenchanted with funds. Because there's this kind of entitlement thing that the funds have had. But what Todd would say is Greenspring just sold to Stepstone, 10 billion to whatever. There's so much information flow you get from being in all these funds, and how stupid the families are to just be enamored with social capital investing with their friends.
Something actionable to that, is I think it's important that this dialogue also you have to be forward, because crypto hasn't been brought up, but that's kind of an elephant in the room. And you had smart money like Sequoia, followed by
Crypto's tomorrow, though.
No, but I'm just saying the blend of this class and the crypto has to be both transparent and logical, because a lot of folks are pointing fingers at Sequoia, saying you were the lead. Then you had, the Canadian pension funds and Singapore following, and that's where a smart VC is going to have to differentiate that touches us as to what's different versus the FTX or these other type things that are getting erosion.
So what's the question?
What's
the question?
I think it's important not to avoid what is going on and how to differentiate versus, you're a good corporate lawyer, how to separate what is a bubble strategy from what's a good business. And I think that's where Sequoia is going to have some problems in their fundraising and heavy going forward. But then other people say,
what do they think about that? Just on this point.
Yeah.
Are you on this different point? Okay. On this point, anyone?
Yeah, I would agree, because Sequoias and others, they don't have to pick. They can easily lump $100 million into something that seems interesting. Yeah. So smaller firms will have to do that. Yes. I think that's
any other comments on that?
Can you finish your comment about the family offices looking at the company versus all of the CDC funds?
Yeah.
Well, and many of you represent the enlightened way to do it, right? And how do we learn? But not just by having institutional capital in our events. You're going to see that in Miami. Well, one, they have to, but number two, the information flow. And then some of the endowment-sized families, they have an unfair advantage because they're in 40 funds. And they see that pattern recognition. And the companies themselves are tough to manage. They're going to make mistakes. Now, what families should do is stick to their domain and add value, cherry pick where they can add value. And if you could, if John could amplify them with his platform, you have to be choosy, not just the ones that just come to you, that really line up.
Can I echo that with a short story? Because
a really short story.
Yeah. Well, it just got longer. Because when I was on Wall Street, I was selected as a top analyst, competing with Goldman Sachs and others. And one of the reasons that I was favored by the institutional investors, because when I would have my conferences, I would not only bring in Yahoos and Googles and eBay and CEOs of those companies, but I would bring in early stage companies. I had access to those things. I remember one Fidelity portfolio manager once told me, Safo, we like you because you show the trends from the smaller firms. So that's what I'm saying there 1 second, that it's really important to know what's going on. Like next year when I'm here, or even well before that, we will see what companies are kind of percolating to do this chat GPT or crypto or other ones. And this will show you the trend not only for private investment, but for public investments, what's going to be shaping the economy in the next 10 years.
Actually, you mentioned a good point, which is for our next conference, what should be trend. So we need to do something like trend, like that we can see where are the trends as a conference, and like that we can decide better where to invest in.
I'd like to comment on trends because I'm taking 20 years of being in the hedge fund industry, dealing with from floor traders with 25 years minimum to high frequency trading, always dealing with brilliant trade thesis. The trade going forward is, and I mean, I'm just saying it because I'm director of ESG and sustainability, but I'm saying that the biggest trade going forward is planet repair. It's going to be the biggest industry in the history of mankind because the size of the solution has to be equal to the size of the problem. It's the biggest problem we've ever faced. So we're looking at future trend being planet repair and anything that's dealing with, that kind of direction of things. It's because right now we're talking about total addressable market, only 8.6% of the global GDP is circular. It tells you two things, that there's huge room and market for expansion and growth into something that, through the last 2,000 years, all of us have gotten really good as a civilization to turn nature into garbage. And so we've got to kind of shift that around. And everything that we do, all businesses, everything, the whole GDP of the world, only 8.6% circular. So talking about next trends, that's the big one.
One thing that I see, I think funds need to invest in the entrepreneur. There's a million ideas, great companies, but I think that what needs to be looked at is the entrepreneur behind the company. How is that person going to pivot? How are they going to adjust, modify? Are they going to give up? I think there's too much focus on the company and too little focus on the management and the entrepreneur and how they're going to be able to weather the storm, because there's going to be a storm for every company, and I don't think enough of that is happening. Not even close.
So, does anyone know Antler? No.
What's the name?
Antler. Antler. You're gonna know that. So it's Techstars, Y Combinator. It's a global, and they all are about the jockeys. They don't even care what your business is. Come into them. It's just accelerator stage, and then they've created a great global.
Where are they located?
Everywhere. They have Antler Nordics. They have Antler Africa. And by the way, how do I know that? Todd Rupert is on their board.
Mark, I just follow on from that. In terms of, are we seeing, I don't know, this is a question, but in terms of VCs and how they're funding, and you mentioned this 12-year exit. Now, are they doing more, are they looking at doing structured exits within their term sheets at all? Or
They are.
They are. Okay.
But the way they're doing it, they're doing
The early stage, because that's one way to solve it.
There is a secondary market for it. We have people who are coming to buy some of the companies we have invested in because now they're $3 billion companies and we invested $12 million. But earlier than that, there isn't enough of a liquid market. I think that's part of the problem.
I think that's the part of there's an AUM grab and then there's this quick out grab. I think that's also faulty.
Well, my thought is that if you've got a cash flow business, that the cash flow from the business can lead to the exit, right? And have the actual, and do a structure, just use the, and it seems like a lot of the businesses that I'm seeing that VCs are funding are not profitable, right? So they have to have the next round of funding. Mm-hmm. My whole thesis is that why not just have a business that generates cash flow and then use that cash flow to give the investor the returns that they want, and that way you can kind of do. Yeah.
I mean, that's the problem though. There's a lot of... Oh, well, that's the trick.
It doesn't go off of EBITDA, it goes off of value of users, revenue multiples, but crazy revenue multiples and not the traditional brick and mortar EBITDA.
No, but remember, venture businesses start completely new solutions that didn't exist before. If it existed,
Takes patience.
it takes patience, and it will take some time to
Short
build.
duration,
Yeah.
correct.
I think the main problem here is that we look at the public company. I spoke with the CEO of NASDAQ 2 weeks ago, 3 weeks ago. Public company are, So public company are well managed. Private company are chaos. So if you bring some of the public company due diligence to private companies, this problem will go away because
Respectfully disagree. That's the topic that everybody's talking
That's
about.
what Joe would say. I'm not going to read from his playbook, but
You can't do that. It will kill the private company. The whole private company idea is that it has to go fast.
But you need to do a better job on due diligence.
There needs to be transparency and cadence.
So
You can't have the fraud. You can't have the fraud.
Joe would say
FTX.
for the jockey needs to be educated on how to reduce the opacity, right?
Yeah, it's fantastic. There needs to be transparency with your investors so your investors know what's going on.
I'm
Because
gonna
if
need
not,
the
the job,
two-minute drill.
That's the IR piece.
Wrapping up.
Okay.
Wrapping up in 2 minutes. And who's speaking for the group?
Sata is.
So I introduced Mark and the guys to Tim Draper. He spoke at another family office event. He wants to work with family offices. You probably know from
Yeah, sure.
Northern
Yeah,
California.
I know him
So
personally,
yeah, so I introduced him to Mark. Mark has to respond, but he could be a good speaker. Yeah, he was very good. He sees 50 to 60,000 deals a year. Him and his whole team, and he's starting a new
60,000?
his team. That's his team. 100 people, I guess. 100 people. So it's a lot of deals. Yeah.
Jack, anything from your side, from what you see in terms of your experience with the VCs, venture world, as well as from the middle of the U.S. where you are?
Apart from what's been discussed here, and I'm picking up on some of the pieces, we look at 6 items in evaluating whether to invest in a venture or private equity fund. Number 1, picks up on your point.
Life settled.
In all 6, bear down and in a granular way analyze. It's hard to do if somebody's investing across 40 different funds. I understand that. The relationship between the investor or investor group and the CEO should be carefully understood in order to develop a cultural assessment. What's the culture that the investor group creates with the IPOs? Pardon me, with the CEOs? Are they put on platform?
It's always
There are my 6 points.
Would you let him finish?
I am not
Yeah, let him finish.
He has confiscated my
Give him his notepad.
60 seconds. First of all, I don't want to quibble, but first of all, I don't believe you're sorry.
Only in pickleball.
All right, keep going.
All right, guys.
You brought up a point that in my opinion, very few people focus on, which is not just who are the people that are back and are they brand name or known or done it before, but what's the culture that puts those leaders on platforms so that they're respected and loved or felt strongly about and therefore can get through the thick and thin, et cetera, et cetera. Number 2, strategy. This is standard stuff, but one needs to see proof that there's no strategy drift in the history of the investor group, because people become distracted and they drift. Number 3 is transparency. Obviously, a lot of discussion from Joe, our colleague, about transparency. Well, blockchain has introduced a whole new way of thinking about transparency. And And it's prompted an enthusiasm for transparency, and arguably it should be absolutely 100% transparent from top to bottom. And we're going to move toward an environment where investors can log in and see everything that's going on in the fund, its operations, and the companies themselves, which will be an important new development. Frequency of communication. How frequently is the investor group communicating, and to what extent is it detailed? You know, a lot of brand name firms send out a little half paragraph, and they think everybody's happy. Well, you know, arguably it should be much deeper, because the investor merits the respect and treatment as such. Here's one that might be different from other lists. Well, this one's not. Diligence. What's the diligence process that is utilized? And there are wide variations when you dig into what do they actually do. You know, there's some that are detailed, multiple gates to get through, etc. And arguably those are smarter and better than the looser, more general ones. And the last point that I'm about to make, because this is going to end apparently, consider favorably funds that are set up to enable sidecars for their investors, so that you're in a fund and living happily ever after, we're assuming, but the managers are identifying situations or opportunities where that you can reach out and have your investor group write smaller checks as sidecars to go in, which gives investors more engagement, more excitement, and the potential to dial up their return from what the fund itself is going to do, because sidecars should only be offered in those companies that are exceeding plan and have a more favorable prognosis. And that is the end. 6 points.
Hey, this is mine too. You did a great job.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.